Hello, and welcome back to the Financial Freedom Show. In this episode, we're going to be reading an article about the 7 best dividend ETFs of November of 2024. If you enjoyed today's video, please be sure to hit the like button and subscribe in order to stay up to date with the latest in my stock market performance, as well as investing advice for ETFs and dividend stocks. So without further ado, let's get started. So looking at this article from Forbes, I'm going to read this article today about the 7 best dividend ETFs of November of 2024. Rising interest rates have set bond prices into the tank, leaving dividend stocks as a preferred alternative. But dividend ETFs make it easier to own a diversified portfolio of great dividend stocks rather than buying each stock individually. Forbes Advisor has curated a list of the best dividend ETFs. We have sought out a balance of low-fee passive funds and actively managed funds that strive to beat the market. We will list the dividend distribution, which is dividend yield over the prior 12 months. So scrolling down, we'll take a look at the first dividend ETF that they mention, which is the Vanguard International High Dividend Yield ETF, or VYMI, with a dividend yield of 4.45%. The next one is the Invesco S&P 500 High Dividend Low Volatility ETF, or SPHD, with a dividend yield of 3.61%. The next one is the Wisdom Tree US Small Cap Dividend Fund, or DES, with a dividend yield of 2.85%. FCF International Quality ETF, or TTAI, with a dividend yield of 2.36%. Invesco High Yield Equity Dividend Achievers ETF, or PEY, with a dividend yield of 4.78%. Schwab US Dividend Equity ETF, or SCHD, we all know this one, with a dividend yield of 3.41%. And the Fidelity High Dividend ETF, or FDVV, with a dividend yield of 2.9%. So we're going to take a look at, first off, the Vanguard International High Dividend Yield ETF, or VYMI by Vanguard. They have an expense ratio of 0.22% with a dividend yield of 4.45% and an average annual return since its inception of 8.73%. After lagging U.S. stocks for most of the past decade, international funds have outperformed in recent weeks. That makes the Vanguard International High Dividend Yield ETF a dividend fund worth considering. It combines solid returns so far this year with a juicy dividend yield that can be trademarked by the Vanguard low expense ratio. VYM provides a handy way to access foreign stocks that pay above average dividend yields. With a portfolio of about 1,300 stocks, the fund owns more companies than any other on our list, offering great diversification. Roughly 80% of VYMI's holdings are from developed markets. About 20% are from emerging market companies. Europe is home to roughly 40% of the holdings, while roughly 25% are based in the Pacific region. About 8% call North America home. So that's the VYMI ETF. The next one is SPHD, or the Invesco S&P 500 High Dividend Low Volatility ETF, with an expense ratio of 0.3% and an average annual return since inception of 8.92%. The Invesco S&P 500 High Dividend Low Volatility ETF builds its portfolio from the stocks included in the S&P 500 index. The fund selects 50 securities from the benchmark index with high dividend yields and low volatility. It hews towards companies that the Morningstar categorizes as value-oriented stocks, mainly large and mid-cap stocks, and the fund is evaluated and reconstituted in January and July. Due to the sector's generous dividends, real estate is SPHD's largest sector. Utility stocks, communication, and consumer staples are big other sectors for this fund, and industrials, energy, and basic materials have smaller roles. So that is SPHD. The next one in the list is DES, or Wisdom Tree US Small Cap Dividend Fund. Wisdom Tree US Small Cap Dividend Fund is split fairly evenly between small cap, value-oriented, and core US stocks that hold dividends. The fund's robust dividend yield suggests that it is a winning approach. Over long periods, small cap stocks have outperformed the overall US market. That gives DES a shot at outperformance over the long term. Another benefit is that the fund pays dividends monthly. Most dividend ETFs shell out payments quarterly. Financial stocks comprise DES's largest sector. Industrials, consumer discretionary, and real estate are the next three biggest sectors. Investors looking for frequent cash flow plus growth potential should check out this fund. So that is DES by Wisdom Tree. The next one is TTAI from FCF International Quality ETF. FCF International Quality ETF has an expense ratio of 0.59% and an average annual return since inception of 5.08%. FCF International Quality ETF aims to outperform its benchmark, the MSCI ACWI EX USNR Index. The fund invests in foreign stocks deemed to be high quality with strong free cash flow and sustainable profitability. To determine high quality, the managers weigh environmental, social, and governance (ESG) issues and traditional fundamentals. TTAI's 154 holdings include roughly equal portions of both growth stocks and value stocks. 3/4 of the fund is at work in 6 sectors, which are industrials, consumer discretionary, tech, financial services, energy, and healthcare stocks. For investors who are seeking income from an actively managed international fund with a focus on quality stocks, this fund is worth taking a look at. So that is the TTAI ETF from FCF Advisors. The next fund in the list is PEY, or Invesco High Yield Equity Dividend Achievers ETF, with an expense ratio of 0.52% and an average annual return from the past 10 years of 9.68%. Invesco's High Yield Equity Dividend Achievers ETF owns the 50 U.S. dividend stocks with the highest yields and a history of increasing dividend payments. The fund tracks the NASDAQ U.S. Broad Dividend Achievers Index. PEY is rebalanced quarterly and pays out dividends monthly. Value stocks comprise about 3/4 of the fund's holdings, with the rest being core equities. The portfolio spans the spectrum capitalization sizes. Utilities account for roughly 25% of its holdings. Financial services are the next largest sector, with a roughly 20% weighting. Over the past 3 years, PEY has shown relatively low volatility based on Morningstar's upside and downside capture ratios. This fund is a great option for investors seeking frequent cash flow payments with an exchange-traded fund that offers decent total returns. So that is PEY by Invesco. The next ETF in the list is one that we all know and love. It is SCHD, or the Schwab US Dividend Equity ETF. It has an expense ratio of 0.06% and an average 10-year annual return of 11.43%. The Schwab US Dividend Equity ETF, or SCHD, sports the lowest expense ratio among our picks. That's a selling point because of this passive fund. Investors have come to expect passive funds to outperform actively managed funds. That's generally true, although active management still tops rivals in categories such as corporate bonds and real estates. SCHD tracks the Dow Jones US Dividend 100 Index. This benchmark focuses on stocks with what SCHD calls sustainable and quality dividends. This means that the index and SCHD want stocks that show promise of being able to continue sharing their profits in the form of dividends back to their shareholders. Like with most of our picks, SCHD favors value and core stocks rather than growth stocks. Value stocks tend to trade at lower prices than their fundamentals, such as dividends, earnings, and sales, seem to call for. Core stocks straddle the border between value and growth stocks. SCHD is well diversified. Roughly 90% of its assets are in 7 sectors: financial services, energy, consumer cyclicals, industrials, and healthcare and consumer staples and tech. So that is the SCHD ETF from Charles Schwab. Lastly, we have the Fidelity High Dividend ETF, or FDVV. It has an expense ratio of 0.29%, and it has an average annual return since inception of 12.23%. The Fidelity High Dividend ETF aims to reflect the performance of large and mid-cap dividend stocks that are expected to continue to grow and pay their dividends. FDVV's mandate also allows it to lend out securities to generate income. About 90% of FDVV's holdings are U.S. stocks. The remainder are from Japan, the UK, Italy, Belgium, Netherlands, and Denmark. FDVV is somewhat top-heavy, with roughly 30% of the fund being invested in the top 10 holdings. Technology and financial services are FDVV's largest sectors. FDVV's non-US allocation adds diversification to the portfolio. It likely aids yield as well. It also screens out the top 5% of stocks in its index with the highest payout ratios to guard against overly risky holdings. Management also uses both payout ratio and dividend growth, signs of financial health, in the stock selection. So if we come down to the methodology, to compile this list, we began with a pool of high dividend paying US and international equity ETFs. We eliminated funds that invest in bonds, like real estate investment trusts, and other certain high-yielding asset classes. Next, we banished ETFs with the expense ratios higher than 0.67%. In general, lower fees boast returns. We also screened out funds whose dividend yields are below 2.67%. Finally, we screened out newer funds that have been launched within the last 3 years. This helps pare our list to about 500 funds. The next step was to discard ETFs with a Morningstar rating below 3. The research firm's star ratings measure the fund's risk-adjusted return relative to open-ended funds in the same category. To make this list most attractive to the widest swath of investors, we barred niche sector funds and selected only broadly diversified U.S. and international high dividend equity funds. 14 funds made it through that screen. The 7 best dividend equity ETFs include a diverse list of fund families and strategies. One of our 7 ETFs is actively managed. Many dividend funds hew towards value, but we also included funds with growth and momentum characteristics as well. You can be confident choosing any dividend ETF from our list to round out a dividend investment portfolio. So what is a dividend ETF? Dividend ETFs are exchange-traded funds that hold stocks with a strong history of paying dividends to their shareholders. When you own a dividend ETF, fund managers ensure that the holdings are always ones that pay out good dividends. Like any other exchange-traded fund, the managers of dividend ETFs choose a portfolio of stocks to match the composition of a dividend index. The resulting portfolio provides holders with an inexpensive, income-generating investment asset. Dividend ETFs can be more convenient of a way to pursue income investing rather than owning and managing your own basket of individual dividend stocks. Unlike the payment coupons on bonds, dividend payments are never guaranteed. That makes maintaining a portfolio of dividend stocks more labor-intensive for individual investors. So how will you choose a dividend ETF? Morningstar lists more than 130 dividend ETFs, making it imperative that you understand how to choose the right one for your portfolio. For example, 2 different dividend funds might have a similar yield, but you might prefer the ETF where dividends have historically grown at a faster rate. When choosing a dividend ETF, you'll want to be aware of the dividend yield. Dividend yield is a percentage of the purchase price paid in dividends during the prior 12 months. If a $100 ETF pays $10 in dividends, it has a 10% yield. Dividend growth, just because a company pays a dividend now, doesn't mean it will continue to in the future. Even if it continues to pay a dividend, there will be no guarantee the payouts will rise over time. That's why it's important for some investors buying into so-called dividend aristocrats. Companies in the S&P 500 have long histories of raising their dividends over time. Dividend quality, this applies to the quality and creditworthiness of the stocks owned by the ETF. If the fund owns riskier companies with lower credit ratings, then it's more likely that the value of the fund will decline, making your total return decline with it. As a general rule of thumb, avoid funds that use riskier companies to boost yields. The highest yielding dividend ETFs may feature more volatile yields over time and less certainty of maintaining those yields. It's not uncommon for the highest yielding stocks to suffer greatly during market declines. That's why it's important to consider the current yield, dividend growth, and quality. Traditional dividend ETFs own companies that don't grow as fast as the overall market. For this reason, investors need to understand the trade-off they might be making when seeking higher yield versus appreciation through growing stock prices. If your goal is simply to earn the most with your money, you might opt for stocks positioned to grow more in value than sell off your shares as you need income for more. Types of dividend ETFs. There are many categories of dividend ETFs spanning index funds, regions, and quality dividend stocks like the dividend aristocrats. Others focus on stock market sectors known for higher yields like REITs, utilities, or on preferred stocks. Below, we highlight some examples of leading dividend ETFs for each major category. Keep in mind that these are not endorsements for any particular fund. They're just meant to highlight the types of funds that you might research as you seek out the best dividend ETF for you. Diversified dividend ETFs. High dividend ETFs include companies that make higher than average dividend payments. Typically, companies that pay higher dividends might have greater risk profiles and be subject to more volatility. International dividend ETFs. International dividend ETFs work much like their domestic high dividend counterparts. They simply invest in international companies instead of those based in the US. This kind of international exposure can further diversify your portfolio. Their dividend payments may be taxed at a higher rate than US companies. Check with the tax professional if you intend to rely heavily on international dividend ETFs. Real estate dividend ETFs or REITs. Real estate investment trusts own shares of a company that buys or loans money to income-producing real estate. By law, REITs must pay 90% of their income to shareholders, making them top choices for those seeking rich dividend payouts. And lastly, dividend aristocrat ETFs. Dividend aristocrats are the gold standard of dividend-paying stocks, making them a go-to for people looking for consistent and steady dividend income. Dividend ETFs and taxes. Dividend ETFs are taxed similarly to the underlying securities within the fund. Even if you reinvest the dividends, they still count as taxable income. Most investors will receive tax forms like a 1099 DIV that explain whether their dividends are qualified or ordinary. Qualified dividends are taxed at a lower rate than ordinary income, such as long-term capital gains. They tend to come from US-based companies. Ordinary dividends are taxed at your regular income rate. International companies or REITs are more likely to pay ordinary dividends. Who should invest in dividend ETFs? Dividend ETFs may appeal to more conservative investors or income-focused investors who would like to generate cash flow. Aggressive investors looking to maximize their total returns may be better served by growth ETFs, which provide the potential for higher capital gains. In addition to income, dividend ETFs also provide for potential capital appreciation. By investing in dividend-paying companies, these funds benefit from both earnings growth and dividend payments. Dividend ETFs may also be a good option for investors who want exposure to a diversified portfolio of dividend-paying stocks, but do not have the time or expertise to research and pick individual stocks themselves. However, it's important to note that dividend ETFs are not risk-free investments. Like with any investment, dividend ETFs can be affected by market volatility and other factors. Additionally, companies can reduce or suspend their dividend payments at any time, which can impact the performance of the ETF. The benefits of investing in dividend ETFs. Dividend ETFs offer a wide range of benefits, including diversification. Diversified ETFs own potentially hundreds of stocks and other securities, providing easy diversification and reducing the risk of exposure to individual assets. Low fees. ETFs typically have lower expense ratios than mutual funds or other investment vehicles, which can save investors money over time. Liquidity. Since dividend ETFs are traded on exchanges like individual stocks, it's easy to buy and sell them. There's typically a high level of demand for dividend funds, making them a highly liquid investment. Transparency. The investment companies that manage dividend ETFs are required to disclose their holdings on a daily basis, giving you plenty of transparency into the fund's composition and strategy. Tax efficiency. ETFs are considered to be more tax efficient than mutual funds because ETFs do not have to sell securities to satisfy redemptions, which can trigger capital gains taxes. Overall, these benefits make dividend ETFs a good choice for income investors. However, it's also very important to do your own research and understand the risks before investing in any security. This has been an article about the 7 best dividend ETFs of November. Hopefully you enjoyed today's video. If you did, please be sure to hit the like button and comment down below what dividend ETFs you're buying and how many shares you own. Love to hear from you guys. And thanks for watching. I will see you in the next video.